Welcome, Rebecca.
Okay. So, hi everyone, I'm Kristen Scanlon from the Scanlon home team. Caitlin could not be here with us this evening, but we do have Jackie, who just recently joined our team and who's very excited to be helping us with showing and taking buyers out and showing a lot of other things. Jackie based out of Suffolk, and we are gladly to be expanding. And we are really honored to have Claribel and Frank Virga here with us tonight to share their backgrounds, their information, and a lot of nuggets for you, right? Because buying and selling a house could be very scary. So if you're buying a home for the first time, what do I need for a down payment? How do I save for a down payment? If you already have a home, but you want to upgrade your home, what do I need to do to sell a house, to buy a house? How does that work? Do I need a mortgage approval? Where does the money come from? Your questions will be answered, and I promise you. So first, we're going to have Claribel Henriquez speak, who is a holistic financial planner. She works with New York Life, and she's a dear friend of mine. After Claribel, we will have Frank Virga, who is operating Team Virga at Embrace Home Loans. He's helped a lot of our clients finance homes recently. He knows everything from how to get approved for a loan to what happens if your house doesn't appraise when you submit an offer and have an offer accepted in contract. He's helped us with so many different obstacles in this market that we're in. And then Kay and I'll represent Kay and and then Jackie's here also to answer any of the nitty-gritty home buying, selling questions. So with that said, Claribel, it's all you.
Hi, everyone. So it's just such a pleasure to be here with everyone today, and obviously to be partnering with such a great team with Kristen and Frank. So I'm just gonna put up a slide. Bear with me for just a second here. All right, awesome. So tell you guys a little bit about myself, more than what you've heard from what Kristen shared. So my name is Claribel Henriquez, and I'm one of the co-facilitators, right? So I just want to really welcome everyone. And I'll start off by sharing a little bit about my background. So I actually hail from a background in beauty. For about 10 to 15 years, I actually worked myself up the corporate ladder. And the further I got up, the less fun I had, right? So I was less client facing. I wasn't engaging with clients as much. And I really started to think about what I wanted my legacy and purpose to really to be. And I started thinking about what really makes everything sort of tick in the world, and it's money. And a lot of times it's also money and education. So I really wanted to impact my community, and I decided to pivot into the financial sector. So now I get to be able to work one-on-one with people, and I really see everybody's faces light up as they're able to really impact change in their lives when it comes to their financial, sector, which is so rewarding for me. So I also want to share a little bit with you guys about New York Life Insurance. So a lot of people sort of hear the word New York Life Insurance and they think it's only life insurance, but it's an amazing company. I wanted to align myself with quality, not only with Kristen and with Frank, but with also the company that I represent, right? And they've been around for 175 years. It's a AAA rated company, and it's a mutual company. Does anybody know what a mutual company is? And anybody could just unmute and share. Okay, so a mutual company is a company that's actually owned by the people that actually own product with them. So it's not run by stockholders, which is really fantastic, right? So you own a piece of the pie. I also want to share a big congratulations if you didn't know it, but the first 10 people that signed up today are actually going to be receiving a one-on-one with me. So stay tuned till the end of the presentation so that way you can see an email with how we can get together. So what we're here for. Oops. Let's just adjust this a little bit. So what today is not about me, it's really about you. And what we'll do in order to be able to guide you through the process of putting yourself in a position to your dream home is the first step is really where I come in as a resource, is I support you in really understanding what you need in order to really put yourself in a position to purchase, right? Purchasing a home is not $100 investment. It's really a couple $100,000, right? So we really want to set you up for success. And I would say probably one of the most underrated parts. Oops, sorry. I don't know why this keeps happening. 1 second. So part of the most underrated part of actually planning for a home is your mindset, right? So that's really one of the most important things. And I really want to acknowledge every single person here today, because a lot of times we're sort of in our heads about what to do when it comes to purchasing a home. I don't know. So then we don't really take any action, right? So the fact that you're here is really amazing. Another thing that in this process is we really want to let go of any of the I shoulds, right? So like, how many times have you actually sat around and go, oh, I shouldn't have spent so much money during this time. I should have probably had way more saved at this point. All of that thought process is really going to keep you where you've been, right? So we want to really stay in action. And it's really about also believing that you can actually achieve it. So like if it takes every single day, you actually visualizing what is your dream home going to look like, right? What is the driveway look like? What does your home look like? Do you want to have a home gym? Really picture that and see it so that you know that it's yours. Now, what we're going to talk about today is really the two types of people that there are in the financial world, typically, right? Typically, there's person A, which typically is going to spend first and save last. And then there's person B, which typically saves first and spends last. So like, what do I mean by that? Well, person A is going to pay themselves first, right? They know exactly how much their bills are. Person A is going to spend first, right? So they're going to buy everything that they want. And then whatever they have left, they're sort of going to put on their savings. So a lot of times as I'm engaging with clients, I sort of ask them, hey, every single month, how much is it that you set aside for your savings? And sometimes I'll get a person A that says, well, I don't really have a set amount. It's just really whatever I have left, right? Person B is the person that's going to save first and really be able to know exactly how much those fixed expenses are, right? Because we all know that our rent is X amount every month. We know what our phone bill is going to look like. We know what our cable is going to look like. Those are your fixed expenses, okay? Now, from person A and person B, right? Which one have you been so far? And it's just a question to be able to ask yourself, right? Have you been the person that spends first, or have you been the person that saves first? Now, regardless of whether or not you've been person A or person B, today you can shift that and make a change that's really going to make a difference for you, or you can continue to be the person that you've been, right? The other question you really want to ask yourself is, from the two, which one do you desire to be? Now, person B is the one that's typically the person that's achieving their goals, that's going to buy their home, not someday or maybe, but in 2 or 3 years, because they've created that goal, right? You really want to put yourself to be in a position where your actions align with your goals. Now, one of the most important parts that I discuss with each and every one of my clients is knowing where you are, right? And what I mean by that is a lot of times, we'll ask questions like, hey, what's your credit score? And sometimes the answer is, I don't know. And that's okay. But you can only know where you want to go or where you need to be by knowing where you are, right? So purchasing a home is really a 20 to 30 year commitment. You want to be able to know where you are. Are you okay with actually taking on the expense of owning a home? So like now, if some of you are renting, and I know that you are because you filled out the form, right? You know that when you rent, you're not thinking about paying water, right? That's an expense that somebody that owns a home is going to do, right? You are not thinking about shoveling the snow in the front, right? Because typically the super or the person that takes care of the building does that. That's something that you would do as a homeowner. You want, aside from your credit score, you really want to know how much money do you need to set aside for closing costs? And that's something that Frank's going to get into a little bit later, which is fantastic. When was the last time that you actually looked at your bank statements? And do you review them every single month? I can tell you that I've actually reviewed bank statements where I've been overcharged. Sometimes it's $50, sometimes it's $100. That money adds up. Knowing where you are makes all the difference. Now, another thing that we really want to look at is what your net worth is versus your cash flow, right? So basically, these indicators are going to support Frank and Kristen in being able to get you the home that you want, right? So your net worth is really your assets minus your liabilities. Your assets are things like your 401k retirement plan, your checking account and savings. Your liabilities are going to be those things that you owe. So essentially your credit card debt, your student loans, your personal loans, and your cash flow, which is really, really important, is going to be your income minus your expenses. So what's the money that you have left after the money that you come in through your income and you take out those fixed expenses? Your cash flow is really, really your discretionary income. It's that money that you have left over to be able to play with. Now, if you find that after you do this exercise, you don't have any discretionary income, you really want to take a look at that and see where it is that you can actually make some shifts and changes. So in this picture, can anybody identify for me, and no, nothing bad towards the millennials at all. I'm not picking on you guys. You probably recognize this memes from a very popular movie nowadays, right? So a lot of times you really have to choose between a down payment on a house, or sometimes it's avocado toast, right? It's all about assessing your wants versus your needs. And when we really think about it, you could be rich making $100,000 and poor making $250K a year. And it really all depends on your habits. It's about managing the money that you have. So as I mentioned, those needs, when we talked about your cash flow and your net worth, those needs are your basic expenses. And a lot of times there'll be things like, you know, your rent, your shelter, your phone, your car insurance, your life insurance, and food. But food could also be a want, right? So how many times have we said to ourselves, you know what, I don't really feel like cooking, I'm going to do takeout, right? Versus going to the supermarket. Or you decide that you're going to have coffee from outside every single day for 5 days, and you're thinking to yourself, oh, okay, it's just coffee, right? At $8 a pop over time, that really adds up, and that really amounts to your lifestyle. It's the lifestyle that you choose to live, right? You prefer to take an Uber versus public transportation. You buy lunch instead of bringing it, right? You have memberships that maybe you never use. It's really about taking a deep dive look so that way you can find the money that you need in order to be able to work towards your goal. Now, when you're looking at your financial goals, you want to look at 3 things. You want to set goals with a time frame, right? So it's not, oh, I want to buy my house someday. No, it's I want to have my house in 3 years. I want to have my house in 1 year, right? You want to look at how you've been managing your debt. And again, what your credit score is, which is really your report card to all of the lenders. And you want to, on top of the down payment for your home, right? You want to set aside closing costs, and you really want to establish an emergency fund, because guess what? The bank is going to be looking at, in the event that, God forbid, somebody loses their job, are they going to default on the mortgage, or do they have extra funds to be able to cover bills for a set amount of time? So you really want to look at things from this perspective. So if I'm thinking to myself, hey, I'm going to need $80,000, right, for a down payment and closing costs. I want to do it in 3 years. So that's 36 months. And you really want to divide that 80,000 into 36 months. We're going to do some quick math, right? You'll need to put away about $2,222. It just worked out like that, folks. I did not do this on purpose. And you know, when you think about setting aside the $2,222, you want to look at, is this a realistic amount, right? Will you be able to afford all of your other monthly bills, your groceries, your clothes, your phone, etc.? Now, if that amount is doable, then you should treat it as any other monthly bill. So again, really being able to pay yourself first, right? Set aside that money. And nowadays, there's so many resources to be able to get us there. So some banks will allow you to set up auto pay. One of the things that I love to do is I set reminders for myself, not only in my calendar, but also, you know, with our nifty friends at home. It starts with an A. I'm not going to say it, or then she's going to start talking to me. But you can really set a reminder. You know, nowadays, I don't know how our parents did it, but like it's so helpful to be able to have those things where I have a recurring subscription and I can choose every single month whether or not I want to utilize it or not. Well, on that day, I get a reminder, hey, and I can opt out of it to save myself some money. Same thing with your auto pay options with your bank, right? Don't be late on your payments, because every time that you're late, the bank sends a message to the credit agencies letting them know that you've been late on a payment, and it decreases your credit score. It decreases your credibility. And when you establish your emergency fund, really, I mean, especially because of what we've been going through the past year and a half, I would say it's really, really good to have 3 to 6 months of expenses. I would even say for me, 6 months right now of expenses set aside. And when I say expenses, I'm really looking at those hard expenses, not lifestyle, right? Because lifestyle you can adjust. The bank's going to be looking at those liquid reserves, and you want to make sure that you have them in the bank. So if we're looking at this from different steps, you want to be able to make sure that you are managing or paying down your debt. You want to save first and spend last. And again, you leverage all of your tools, create those auto payments so that you're not late. You want to save 3 to 6 months of expenses, and you also want to have your closing costs. And you really want to be able to get your credit score in check. So every year you are entitled to a free credit report. I'm going to be putting my link tree in the chat box later, so that way everybody can get access to that. You can just click on my link tree and there'll be a link on there in order to be able to access your credit report. Request it. It takes less than 10 minutes, and then you'll get a full report on there. The biggest mistake that people do is that they don't look at their credit report. There might be people, for instance, I don't understand why. I guess I do because I'm Hispanic. My mom named her daughter her same name, right? So my mother's name's Maritza, my sister's name is Maritza. Guess what? Their credit got jumbled because they thought that they were the same person. So my sister's school loans went on my mother's credit report. You really want to make sure that you are getting that cleared up. So definitely request that if you don't already have one or you haven't requested one for the year. And in this process, Frank will go more into this, but you should have at least 2 years of documentation. So the bank wants to know, hey, Claribel's been making her payments. She's been able to sustain this lifestyle and save this amount of money for this amount of time. You know what? She's somebody great that I can lend to. You want to be consistent, right? Now, how much home can you actually afford? Well, this is where actually going through the pre-approval process is really going to support you, because It doesn't pay to actually look at homes that are worth $2 million if you've only been approved for $1 million, right? So you really want to be in partnership with Frank and his team, as well as Kristen. And then nearly all mortgage loans and lenders require some amount of cash as a down payment, as we discussed. The amount that you've set aside for this will really determine the kind of mortgage that you qualify for. It will impact how much you can afford or borrow for your home. And it's important to note that there are over 2,000 home buying assistance programs in the United States that offer down payment help in the form of grants, low interest or deferred loans, forgivable loans, or other programs, as well as help with closing costs, right? So this is my portion. I know that in this hour and a half, it's hard to be able to pack all this information. So if you'd like more information, please feel free to reach out to me. And then, like I said, I will put down my link tree in the box. So I will pass it over to Frank and Kristen.
Thank you so much, Claribel. And I think you offered a lot of information. I often hear sometimes clients move into a house and they don't expect to have to pay for a water heater that goes or a leak that happens. And obviously there's insurance and different things that could help with those costs, but you always want to save for a rainy day. And I'm trying to go into a little bit of what you need to do on how to get pre-approved, and then we could also go into how to use the equity. I saw Jackie asked a question: how do you use your equity that you already have in a house in order to buy a new house? And in this market, we've done it quite a bit, Frank and I, for a couple of different clients. So, Frank, you want to take it up?
Thanks so much, Chris. So, guys, thank you so much for taking some time tonight. My name is Frank Virga. I'll give you a little bit of background on myself. And, on the mortgage end of things, it really just, there's so much that I could cover, right? We could speak about, everything from credit history to down payment to closing costs, the different type of loans out there. I mean, I could eat up an hour and a half of everyone's time. And Claribel, I think you did such an amazing job just kind of setting a really good path for us to go down tonight in terms of savings and budgeting. And you touched on a lot of things that we kind of speak about with a lot of our first-time home buyers, or really buyers in general. And first and foremost, it does come with starting with a plan, right? Myself, much like Claribel, my title is actually Certified Mortgage Planner. I've been ranked among some of the top mortgage planners the last 4 years in the country. And what we try and do when we start the pre-approval or pre-qualification process is exactly that, right? We're going down a path together. We're setting aside a plan of, hey, this is our goals, right? This is where we want to be in 3 months or 6 months or 9 months. How do we get there, Frank? What are the best paths for us to take? Is it, starting a pre-approval now and then starting our search right away? Is it, hey, we have some upcoming job changes or income changes or things that may benefit our situation, maybe relocation for jobs. So we really try to sit down with our borrowers or do a face-to-face via Zoom or an in-office meeting. What we really want to do is just pull as much information as we can from you guys to help put together a plan with you. And like Claribel and Kristen said, one of the first things that we want to do is start the pre-approval process. One of the first questions I get asked is there a difference between pre-qualification and pre-approval? And there is, especially in this market right now where we really need to set everybody's best foot forward when it comes to seeing and touring homes. And a pre-qualification is more of a informal type of qualification letter where we have a conversation. We will discuss things like income, assets, what you feel your credit history is, and a pre-qualification letter will be generated and passed along to your agent. A lot of what happens though in that pre-qualification is kind of it's left very open-ended. No documentation was reviewed. How someone gets paid a lot, right? Someone say, hey, I may make $80,000 a year. But is that a W-2? Is that 1099 income where you're virtually a self-employed subcontractor? So we aim to push all of our borrowers through the pre-approval process where we want to collect the proper documentation, pay stubs, W-2s, tax returns if you're self-employed, any asset statements that you may have regarding checking accounts and savings accounts, retirement accounts. Like Claribel said, there's going to be some level of reserve required when purchasing a house. So we're going to collect that documentation. We're going to run your credit. Okay. We are going to make sure that we are dealing with the most accurate scoring model, which is a FICO model. When we run credit, it's through a FICO model. And basically it's going to spit out a full credit history from the very first credit item you've ever had up until the most recent credit reporting period, which is the 27th of the prior month. So what's going to happen is we're going to run your credit. We're going to review your documents, and we're going to issue a pre-approval letter. That letter will get sent to your agents, Kristen and Kaylin. And now this letter is going to be the most accurate document in terms of the price point of a home that you should be looking at. Pre-approval, and one of the most important things I'll always say on one of these seminars is pre-approval does not equate to affordability. So what that means is when qualifying for a mortgage, we use your gross income. Okay. We use, we don't use your net. We don't use your take home. We use your gross income. So if someone makes $100,000 a year combined as a couple, we're going to use $8,333 a month in qualifying income. That income goes into what we call a debt to income ratio. And this helps us get you qualified for a loan. We know, obviously living in New York, we have multiple levels of expenses, right? We have state taxes, we have federal taxes. If you live in the 5 boroughs, you have a resident tax. So your take-home income is going to be drastically different than your gross income. So when qualifying for a home, yes, you may be pre-approved for a $500,000 house, but we have to see how that impacts you in terms of your day-to-day living expenses. Because when we're putting together a pre-approval for you, we're not calculating secondary expenses. We're not calculating what we feel that the heating cost, the water cost, the car insurance cost of a new house is going to be. So it's what we call your primary expenses, which are items that show up on your credit report, i.e. credit cards, student loans, car payments, installment loans. And then the expense of the new house, what we call our PITI payment, principal, interest, taxes, and insurance, are what's going to be factored into your debt to income ratio. So your pre-approval may say, hey, you know what? They're great buyers and they're qualified for a $500,000 house, but that may extend you guys or extend the buyer to the limit where they're no longer comfortable, right? Because after they start to factor in their take-home income, and Claribel mentioned about a monthly cash flow, that may put your cash flow in a negative, right? You could be pre-approved for a home, but have negative cash flow each month because now your gross income is used to qualify, but your net income after expenses is less than the actual expense itself. So what will happen is we will do an initial pre-approval. Before sending out that pre-approval, we will have a call talking about spending habits, right? What other expenses do you take on a monthly basis that, and how will they be impacted if we now purchase a house that's going to run you $2,500 or $3,000 a month? And we may have to cut back. I mean, that's just a fact of life, right? We may have to scale back from going out to eat 3 days a month to going out to one, or an expense of, hey, I go to Starbucks every day and we spend $20 at Starbucks. We may have to start cutting out material, things that we're used to in order to qualify for a home or be comfortable. And ultimately, I have more often than not, and I had this conversation this evening with a buyer where an initial pre-approval of $500,000 was done. But when we got into the nitty gritty of their spending habits and the fact that they like to travel once a year and these other expenses, we really had to put them into a situation where they should have been in a $425,000 price point because they were cutting out so much of their everyday, creature comforts, so to speak. So pre-approval doesn't equate to affordability, but it is the best way to set you, on the right path to home ownership. Anything less than that in terms of a pre-qualification is just not doing enough due diligence upfront to get you down the right path and give you and your agent the right amount of clarity in terms of the price point of a home that you should be spending. Nobody wants an unsuccessful homeowner. Nobody wants a buyer that closes on a house and in 6 months from now, 3 months from now, they're miserable. They're unhappy. They're cut out all their creature comforts. That's not what anybody wants, right? We want to set people up for successful home ownership. And the only way to do that is full transparency, full clarity, and just, being so granular with it, right down to your everyday occurrences, right? Your gas, your travel to the city, your subway, your Long Island Railroad. I mean, these are expenses that you're going to have no matter what. These are expenses that you incur to do your job. And the only way to do that is to get as granular with it as possible, with really just, a meeting or a face-to-face or a phone call, and say, hey, yes, we're pre-approved, but let's dial this in and make sure that this is the right number for you. So that's the difference between pre-qualification and pre-approval, right? And a lot of what Claribel kind of mentioned, I don't want to overlap too much, but credit is a big piece of this. Credit will dictate how much you're pre-approved for. Credit will dictate the type of loan that you're pre-approved for. Credit will dictate whether you even can be pre-approved for. There are minimum score requirements when taking out a mortgage. There are minimum down payment requirements that are going to be piggyback on your credit score, right? So somebody with a lower credit score is going to have a higher down payment in a lot of cases, depending upon their loan programs and things like that. So credit is really the most important thing, or one of the most important things when taking out a mortgage. And you do want to make sure that you're in a position, the best position moving forward when it comes to credit. And really, there's a couple ways to do that, right? One, the most common, pay your bills on time, right? I mean, it's really simple. Every month, the occurrence of credit cards, car payments, those things have to be paid on time. By paying them on time, they're going to report, that they're being paid on time. They're not going to have any derogatories in your credit report. Managing the debt part of it, installment loans are really easy, right? An installment loan being a being a car payment, being a student loan, it's a fixed amount, right? You can't borrow anymore. You have a payment of $400 on your car, you make the payment, your balance goes down, eventually you pay the car off or the lease goes back. And it's really hard to kind of make that hurt you outside of just missing a payment. The revolving debt, it's what so much of your score is weighed on, right? Because it's really easy to obtain a credit card. How you manage the credit card itself, or the credit cards itself, is ultimately where a majority of your score is going to come from. So someone gives you a credit card, let's say it's a Visa or MasterCard with a zero balance, and you charge that card up to a $3,000 balance, and then you continually start to make the minimum payments on that card. You've showed the ability to borrow, but you haven't showed the ability to manage that debt now. You're just making the minimum interest payments every month. And by multiple months of doing that, you're actually hurting your score more than you are helping your score. So really what we try to tell our customers, that when you start to put a timeline to buying a house, you do want to make sure that you're keeping your revolving debt ideally in a 30% or less threshold. So, for argument's sake, if you had a $3,000 balance, you really want to make sure that you're not carrying a month-over-month balance over $1,000, right? You're keeping the balance low. You're making extra payment towards the principal. You're managing the liability now, really responsibly, and that's what's going to help your credit card. Your credit score. American Express is always a really good card because it almost forces you to pay it off every month, right? Depending upon if it's an open card or revolving debt, but it forces you to pay off your debt every month. I know a lot of people don't like that, but when it comes to scoring, you almost want to treat every credit card like, hey, I have an open card and I have to pay this thing off every month, or keep that balance really low. And by doing that, you're putting yourself in a position where you're going to optimize your credit score. You're going to keep your balance, which your monthly payment is going to be tied to, at a very low amount, which is also now going to benefit your debt to income ratio, right? If we're carrying a $400 payment on a credit card, it will limit your purchasing power compared to a $40 payment on a credit card. So you want to make sure that you're managing the revolving debt really as responsibly as you can. And that's by keeping it at 30% or less. And ultimately, when you could, paying that down to a zero balance. Now, you don't want to close cards that you're not necessarily using, older items that you haven't used in 12 months or longer, you could pay off and close those items. But you do want to make sure that the other items that you are using, you're keeping down to a minimum, you're making extra payments, you're hitting the principal, to keep yourself really in the best scoring place when it comes to credit. Chris, any questions coming in at this point now regarding certain loan
Yes.
programs? I
So-
mean, I can go into closing costs and all that as well.
Yep. So Alexis said, if you and your partner go onto a mortgage, which credit score will they take?
That's a really great question, Alexa. So there are 3 credit bureaus. There's Experian, there's Equifax, and there's TransUnion. And they each are going to vary slightly in the scoring, in the score itself. So what happens is when there's multiple borrowers, right? When there's more than, there's 2 or more borrowers on a loan, it will be based off of the lower of the middle credit score. So what that means is you have a high score, you'll have a low score, and you'll have a mid score. And the mid score is what's used to qualify for a mortgage. Now, when you have 2 borrowers on a loan, or I've had plenty more than that, but if you have 2 borrowers on a loan, it's the lowest of the mid scores. So if you have a 736 mid score and your partner has a 686 mid score, the 686 score is what's used to grade the loan, right? The type of loan that you qualify for, your interest rate that's attached to that loan, and the loan program will be graded off of the lower of the mid scores when there's multiple borrowers.
And that's important, right? Because a lot of times I do have a lot of first-time home buyers or friends are like, hey, I want to buy a house, like, but my credit score, and even now, even if you're not buying a house and you're renting, a lot of agents are going to ask what's your income and credit score, right?
Absolutely.
For even
Absolutely.
rental. So these are things that you really want to make sure are solid. Another question, which I typed an answer, but if you have anything to add, Frank, basically they asked, does equity in a current home work as cash in this situation? So I explained basically, if you're looking to, you have a home right now, you built equity in it, and you're looking to buy a new home, say your house is listed for sale on the market, it goes under contract. Once it's under contract, you find a home that you want to purchase. Now, in New York, obviously there are some people out of state here. You do need a down payment in order to secure and go under contract. So you're going to need some cash or some type of asset, cash, borrow money from someone to be able to put down as that good faith deposit to go under contract. Now, the remaining equity of your home could be used at closing, as long as
Correct.
the house that you're selling sells first before you buy the other house. And usually it has to, if you have to sell to buy. So,
Kristen, is that good? Sorry, is that good faith money? Is that the same thing as earnest money? I've heard that term used before.
Yep.
Yep.
Yeah, EMD is technically earnest money deposit, down payment. You can call it, really any of those things. But yeah, it would be one and the same. And to kind of piggyback on what Kristen said, and this is a question I think that we probably got more in the last 2 years with so many people that were looking to trade up or really just change the way they lived, right? COVID, brought on, for everybody, right? We started to reevaluate how we live, right? Whether it be, hey, do we just need more space? Do we need to downsize? Do we need to relocate? I mean, people really had a lot of time in their homes to start to evaluate the way that we lived. And we come across this question, it could be a dozen times a week. And that's, hey, Frank, I have this house and we have this equity in this property, but how do I leverage that equity to be able to use it on a new home? And it's not as simple as like, hey, I have, $300,000 in equity. We have to figure out how we're leveraging it. Well, are you going to be selling that property? Well, we are, but we don't want to sell that property maybe before we close on the new one. Well, now we can't really use that equity, right? Because that home is not going to be sold. We're not going to have the cash in hand, so to speak, from selling that property. So we may have to start looking at alternatives, right? Now we have to start talking about leveraging, maybe a retirement account or a gift from family or something along those lines. Or maybe we just have to take out a bigger loan and then we could pay down the mortgage after we sell. So we like anything else, we have to start to evaluate what options we have. If it's like, hey, Frank, we are going to be selling and, we're going to put our house in the market and we're going to sell. Great. We can leverage that equity once that house sells. And it could be the same day. We do it all the time, right? You'll sell in the morning and buy in the afternoon and you'll have that equity to move down the line, so to speak, on the new home. But we still have to figure out the EMD or the earnest money deposit on the contract signing, right? Because most cases you're talking between a 5 and 10% or maybe more down payment. So if you're buying a $500,000 house, we still have to come up with $25,000. So that money has to be leveraged somehow. And if we can't get it through the equity of the house because the home's just not going to be sold yet, Now we have to start being creative in terms of where am I going to come up with this money to just go to contract, right? And it may have to be like, hey, we're going to leverage it through a gift from family and we'll pay them back once we sell the house, which is more common than it's ever been the last couple of years for us. But also we have clients that will leverage it through an investment account or retirement account, and we have to figure out the logistic of that. But we do have to get creative because sometimes having that equity there, it just isn't enough, right? There's no way to leverage it. We have to figure out how do we get the equity out. And really the only way to do is to be able to ultimately sell that house.
So Alexis,
How much is the earnest money or good faith money? Like how much should we usually budget for something like that? Is it a percentage or?
Chris, I guess I can let you answer that because we see it. Yeah, it really depends.
Jackie, where are you based out of again?
Cumming, Georgia. It's just north of Alpharetta. We're looking at selling probably around like 450 and buying in the 600 range. So we have a good amount of equity, but we only have maybe about like 15 or 20 grand in the bank. And I don't know, is that enough for earnest money or do I need to worry about saving?
What I could do is I could reach out to, send me a message on the side with the exact town and area you're in, and I'll speak to a couple of agents from Keller down there just to kind of get a feel for like how the market's moving, if it's similar to Queens and Long Island in New York.
Okay.
Well,
and we do have a friend agent, I think with Keller actually. So I can shoot that to her as well, but
Frank,
yeah, I can answer this. So it's funny, actually, one of the assistants on my team actually lives in Cummings, Georgia, which is pretty funny. So,
awesome.
we do a lot of business actually in Georgia, and Georgia a little bit different than New York, right? First of all, contracts work differently, right? Contracts are not handled by attorneys there. The realtors basically writing up contracts. They're 1 or 2 page contracts. Rule of thumb that we see down there, I've had clients right now that are in contracts, or the team, guys on my team, that they'll go to contract with as little as $5,000 or $10,000. But really any state, doesn't make a difference if it's Georgia or New York. It really is a negotiation on the initial offer, right? So if Kristen was representing you guys in New York, she may present that with, hey, you know what? It's a $600,000 offer price. We're going to put down $10,000 on contract. The remainder of that down payment is going to come from the equity of their house, right? So the pre-approval will be written that way. Let's say, hey, we're going to come up with 20%. It would be 10 on contract. The remaining $110,000 would be on closing. So you would still look like a very attractive offer, right? We have 20% down. We're mortgaging 480 on 600. We're going to put 10,000 on initial contract signing, and then the remainder would come from your equity. So it's a negotiation like anything else. There isn't a set dollar amount. I mean, listen, every seller wants to see that every buyer is putting down the most money possible. But realistically speaking, every seller was a buyer at one point, right? And at one point in time, they were putting down, what they could afford to put down. So it's a negotiation like anything else, right? And I think, your agent would walk you through that and say, hey, listen, we have a really strong pre-approval here. And the way we're going to structure it is this: $10,000 down or $5,000, whatever that number that you're comfortable with would be on contract signing. The remainder at that point then would be due on closing when you sell your house. And things down in the, in the Georgia area move a lot differently than New York. I mean, most of those contracts are 30-day close contracts. Where in New York, I mean, all bets are off.
It depends if you're a cash or a mortgage in New York. So Alexis, if you're a first-time home buyer, what's the lowest percentage amount down? So technically the lowest is 3.5% of the purchase price. However, in a market that we're in, it's a little bit harder to get you a house with 3.5%, 5% down, 10% down, right? Because houses, especially in Long Island, are going over asking, and then you have to worry about appraisal issues. And, if a house doesn't appraise, you want a little bit more money down. Frank could go into more details of what happens when a house doesn't appraise, but we've seen it more than I think one of the first deals I did with Frank, we went $65,000 over ask in Massapequa Park. And literally the house probably appraised like what, $5,000 or $10,000 under the.
It was only 5 or 10,000 off.
It was low, but they were putting more. They were putting almost like 35% down. So it really didn't impact them. But if you were putting 3.5% or 5% down, that's going to be a big deal.
So, and Chris, great point, Chris. And to piggyback on that, so there are really strong first-time home buyer products out there, right? You could put down 3.5% on an FHA loan. We actually even now offer 3% down on conventional loans. There's a Sony May loan with Sanford State and New York Mortgage Agency, which is really geared towards the quintessential first-time home buyer. So there are options out there. Kristen said, though, right, in a market that's so super competitive right now, it's very tough for a first-time home buyer to compete with a 3 or 5 or even a 10 or 20% down payment when you're competing against so many multiple offers that are maybe cash, or maybe they're putting down 50%, or it's a very difficult time to be a buyer, right? You have very tight inventory, especially in the, $350,000 or $300,000 to $600,000 price range. You have very low interest rates, which makes everybody very attractive to be a buyer right now. And then you just have, just a tremendous amount of volume right now in terms of the amount of buyers out there. So it's a very competitive market. One of the things that we do a little differently, going back to the pre-approval, right? So we always want to set our buyers up for success, right? We want to set them up for success as first-time home buyers, as buyers in general, but we also want to set them up for success just to get an offer accepted. So a pre-approval, far and away the best way to start, right? A pre-qualification is just not something that is going to be acceptable in this market. So pre-approval is the best way to start. We've taken it a step further here at Embrace, and we do something called an approve to move, right? Where now you have your agent, right? We have your agents on board, and you've identified a couple of properties, and you say, hey, you know what? We're ready to take the next step, Frank, before we start making offers. And we really want to get a formal loan approval. Pre-approval is not cutting it, Frank. We're putting down 3% or 3.5%. And maybe it's just not enough, right? We're losing steam when it comes to making offers. We'll actually take your loan. We will have you sign an application. We will submit your loan to underwriting and now issue you a loan commitment. This is a fully approved loan commitment, okay? There's no property address. There's no contract of sale yet. But what you're going to do now is you're going to be able to go out there and make offers with a fully underwritten loan commitment. So we've kind of adapted this more and more in the last 2 years with COVID, because we have so many buyers that are really strong buyers that are putting down 3% or 3.5% or 5%. And they're as qualified or sometimes more qualified than the buyers that are putting down 10 or 15 or 20%. But sometimes on paper, it's just not enough. So we formulated something called Approve to Move that has gained so much traction over the last 2 years. And now you're going to go out there with a full commitment, right? You're going to go out there and be able to show, or Kristen's going to be able to show an agent, hey, I have a buyer that their loan's already approved. So we're going to make this offer with an approval in hand, with this loan commitment in hand. And we had greater success, we have greater success than most other places now, because other places that are going in there with a pre-approval or a pre-qualification, our buyers are now rolling in with a full commitment. Their loan's already been vetted. They've already been underwritten. They already have a commitment now. So our buyers have a greater success rate when it comes to accepted offers when they have a commitment compared to even a pre-approval, which is so much work. This takes it a whole nother level. It takes it to a whole nother area now where this thing has been approved. Now it's just a matter of finding a home, entering into contract of sale, and really just closing. So there are options as first-time home buyers, and we're going to continue to evaluate how there are different options when we have a buyer that's bringing in maybe a little bit less cash to the table with a lower down payment product. How do we get them an accepted offer? How do we get them to be seen in a better light?
And I've worked a lot with Frank on a lot of this because it's been interesting market. It's something that we all had to shift, pivot, and adapt to. Another thing is find yourself working with professionals who are connected to other professionals. Like I've gotten offers accepted because they know Kay and I, who we work with and how we work and how we operate. Basically, they knew we would get the job done. If something came up, we'd be able to figure out a way to make sure we got to the finish line. So that's really important too, is like knowing. I mean, I've gotten a couple of deals in Manhasset accepted. That's almost like an impossible market to even like get into unless you were born, raised, and bred there. But I think I've already sold 3 or 4 houses there in this year. So these are things that you just really want to like make sure that you're working with someone that's got a friendly personality, that want to work with other agents. Like we know if there's a difficult situation when we're putting a long stretch offer in, I'll call Frank and be like, hey, I just submitted this offer for this buyer. You approved them. Can you do me a favor? Here's the listing agent's phone number. Can you call the listing agent and basically sell the client's credentials to the listing agent, let them know that, hey, if it doesn't appraise, like this is how we could rework the loan, right? Knowing these things up front, like as an agent and the people that you're working with, you want to make sure they know these things because you want to be in the best light when you're going to put an offer in this market. Because if it's a house that's pristine, lines down the block, multiple offers, bidding wars, it's Queens and Long Island, right? If it's priced right. If it's overpriced, you may see it sitting on the market a little bit as well. But those are different things. And I want to be mindful of everyone's time. So I do want to see like what questions everyone has. If you have any questions, if there's anything you want us to cover on the home ownership, on the saving, on the financial planning, because that's what we're here for. So we want to open it up to some questions for you. And Isabel said, I missed it, but are the FHA programs a good option? So there are many great FHA programs out there, like Frank said. Currently, as an agent, it's just a little bit more difficult to get offers accepted if it's going way over ask. It depends. It's case by case situation. It's like the seller's motivation gets tied into that, right? How quickly the seller wants to move. Do they want a cash offer? Do they want to give somebody the benefit of the doubt and a chance? So FHA are great options. It's just in this market, if you're going way over ask, it's going to be a little bit harder if it doesn't appraise to come up with the difference in money. I mean, at one point during this market, buyers were waiving appraisals. So if it didn't come up for that amount, you had to come out of pocket, put a little bit more money down at that time.
Yeah, and you know, to piggyback on that again, you know, FHA it's a really nice option. It's a very it's a common loan program amongst first-time home buyers, and there's a couple of reasons why. One, it's the reduced down payment, right? You can put down as low as 3.5%. FHA stands for the Federal Housing Administration, right? So it is a government-insured mortgage. It's a government-backed loan. It's been around forever. It carries very low interest rates, very attractive interest rates. Now, I'm not saying it's the cheapest loan, but it is. It carries a lot of attractive qualities to it. It allows for a lower credit score. So basically, you can go down as low as a 580 credit score. So if there were some hiccups in the past, right? If there were some delinquencies, some latenesses, some collection accounts, I mean, we've all been there, right? You know, you have things happen, right? You lose a job, you know, get some credit cards in college, you're not paying for a couple of years. I mean, we've all been there, and FHA kind of fills that void when it comes to, you know, you don't even have to be a first-time home buyer, but it fills the void to allow people that maybe have a hiccup, right? To kind of explain away, you know, oh, I had a bankruptcy a couple of years ago. We had a foreclosure years ago. It allows for those kind of things. It allows for a lower credit score, it allows for a lower down payment. I would say an FHA loan probably makes up 50% or so of the market. I mean, it does fill a void. It is a good loan. I don't know that I would call it a 30-year loan for somebody. And the reason being is when you put down less than 10% on an FHA loan, FHA loans carry what we call mortgage insurance premium, right? It's an MIP. It's not PMI. PMI is on the conventional loan side, which is private mortgage insurance. It's a third-party provider. Mortgage insurance premium is through the FHA, and it's comes along with the loan. When you put down less than 10%, you have it forever. There's no getting rid of it. It doesn't matter when you get to 20%. It doesn't matter, you know, if you had the loan for 20 years. As long as you have that mortgage and you put down less than 10%, you have mortgage insurance on an FHA loan. So it's a more expensive loan option in the long term, but it does kind of act like a Band-Aid in the short term in terms of maybe getting you in the property, get you an attractive interest rate. It does make it affordable, but it is something where in the next couple of few years, you'll hear from me as we do our annual loan reviews, where we will review, you know, hey, it's been 12 months, you're in the house, how you doing? Are you making extra payments? Do you want to talk about refinancing? So we'll do an annual loan review with all of our customers. And that's one of the questions for someone that's been in an FHA loan for a couple of years is about maybe coming out of it when the time comes and they have additional equity in the property. Maybe credit scores are in a better scenario or better situation. We'll talk about maybe refinancing out of an FHA loan to get rid of that mortgage insurance premium, lower monthly payment, and ultimately put them in a nicer loan for the long term. But an FHA loan is one of the more common options in this market.
Absolutely. You do see a lot of people with them. And then there's additional requirements that the house has if it's FHA
Sure.
versus conventional too. So it's, you got to make sure that there's certain things in the house, like I know certain railings have to be set up. And sometimes some of these flips don't always tick
Mhm.
inside their boxes. So like that's
Yep.
important to make sure you're aware of that also
Yep.
for some home buyers.
Absolutely. Absolutely.
Does anyone else have any other questions, or is there any topics that we didn't touch upon that you'd like to learn a little bit more of, or that we could help you on?
I had another question. So you mentioned before that in this market, there's some buyers waiving appraisals, and that's happening a lot here right now. Coming is hopping apparently because houses are going really fast. Is that something that you would really warn against? Or if we are going to do that or consider offering that to make our bid more attractive, are there things we should be doing to make sure that we're not buying a lemon?
So what I always do is regarding appraisals is one, as an agent, I'll never submit an offer for a client that I don't run comps on of stuff that's recently closed. So Kay and I, if a client says, hey, Chris, like we want to submit an offer, like this is what we're thinking. I say, okay, let me just make sure that we have apple to apple comparisons that when the appraiser comes, at least I could say, hey, like this recently sold for this price. Whether he appraises it or not at that price, that's a different story, right? So we do that for our clients. We've waived appraisals up to a certain dollar threshold that we believe that the price would appraise for based on what recently sold, instead of waiving the full thing, which has made it a little bit more attractive than just saying, hey, I'm submitting the offer without a waiver. So it's really case by case basis. I would highly recommend, if you're going to be submitting offers on property, make sure that there's in by area for similar properties.
Okay, and then similarly, and maybe I was getting too confused, I've heard of some offers going through without inspection, and that just gives me the heebie-jeebies. So is that a big no-no to avoid, or?
It depends on the house and it depends on your process, right? So for example, I've had clients that in New York and especially Long Island, most of our clients are submitting offers for educational purposes with inspections. Like we're not allowed to use, not that we're not allowed, we are legally allowed to use inspections as negotiation factors, but in this market, if you start negotiating, they just go to the next offer and the next offer and the next offer. So
yeah,
you submit offers and say, hey, my client would like it for educational purposes. I would never fully waive it unless you have money to make sure all these repairs have to be fixed. Like we had one, it's one of Frank's clients and our client, they did an inspection and there was a lot more that needed to be done and she backed away. Yes, she lost the money for the inspection, but that's a lot cheaper than walking to a house that needs 10 to 15 to 20 to $30,000 of work. Is that helpful?
it is. Sorry, I couldn't find my mute button. Thank you.
Okay, Erin.
And this is all kind of new, right? I mean, we didn't see this, pre-COVID, but this became like a thing where it's like, the buyers that waived the most contingencies, felt like they had the best opportunity to win a house. And listen, in some cases that was true. I understand the appraisal piece to a certain extent, but we have to really talk through that with our buyers, with the agent collectively. Like Chris said, and I knew she was going to go there because I know exactly how they run their business. It's super important to work with an agent that knows the area, that's going to pull comparable sales. Kristen and Kay, I mean, they have the same access to what the appraiser is going to use when an appraisal is done. So I know if they come back to me and say, hey, Frank, this is where this house should appraise at, this is where it's going to appraise at. And we've had these conversations dozens of times. And it's so important to work with an agent that has that kind of knowledge, because it is important, right? You start waiving inspections or waiving appraisal contingencies, especially if we're not putting down a tremendous amount of money. If we start putting down 3 or 5 or 10%, and this thing under appraises by that amount, we're going to either start jeopardizing down payment that you put down on contract, your EMD, or now we're scrambling to try and fix this problem, right? That could have been avoided if the agent was like, hey, we're not getting to this number. And then we could start to reevaluate our offer, right? Are we putting in an offer, non-contingent appraisal or not? And if the agent's saying, hey, I don't like where this is headed in terms of comparable sales, then we're not going to start waiving an appraisal contingency and things like that. So the transparency piece on buying a house to me is the most important thing. It is really easy to start going, oh, well, it's interest rate, it's this. The transparency piece of buying a house between your agent, your mortgage professional, if you're in New York, your attorney, that type of knowledge, because this is what we're doing every day, right? This is what we're seeing every single day on every single transaction. And we're just taking our knowledge and we're just passing it on to our buyers is the most important piece. I mean, I don't know that I could even state that enough, because everything else is secondary. I see that people are waiving inspections. I kind of cringe a little bit when I see that, because you don't know what you're getting. A lot of these houses are 40, 50, 60, 70 years old, and there's just so much that could be there. Not every inspection is coming in is going to be pick up everything, but you want to give yourself the best chance of being a successful homeowner. And it goes back to one of my initial thoughts, and it's setting yourself up for success. Well, waiving a $500 or $600 inspection just so we win a bid, it may not always be the most prudent thing. But what Kristen was saying is, hey, we are going to do an inspection. We're not going to renegotiate based upon that inspection, but we want to do it for our own purposes or for our own knowledge, I think is a good way to sell it. To say, hey, we're just going to go out there and we're just going to trust that everything that was done in this house was done correctly. And, there's a safety issue there. There's an overall concern when I start seeing things like that. So I do think that working with an agent that is going to properly guide you through those steps when crafting that offer is one of the most important things.
Yeah. And like the other thing I always tell to our clients too, is sometimes they get so stuck on what the price itself costs, but you really want to look at the affordability of the monthly payments of how much you could afford each month, because people look so much on, oh my God, I will wait till the houses go down to 450,000 instead of spending 500,000. But people don't realize right now houses at 500,000 at 3% interest is actually saving them $70,000 over the life of the loan if that 450 was at 4% interest, right?
That's correct.
You're saving $50,000 on a home price, but you're really paying a lot more when interest rates go up monthly. So your affordability, goes down when the interest rates go up. So that's just something to keep in your back pocket, especially there are projected to have interest rates going up in 2022.
We're already seeing it, Chris. We're seeing pressure on interest rates right now. A lot of what's happening in terms of government stimulus and where the government has kind of the Fed has stepped in and they're buying what we call mortgage-backed securities, and they're kind of artificially keeping rates low. We're seeing that end right now. We're seeing pressure on rates. It's going to be a difficult market, continue to be a difficult market for buyers in general. I think in 2022, we're going to need more inventory. We're going to see pressure on rates. It's going to start to impact people's purchasing power. So there's a lot of things that are happening, but we are going to still see appreciation. I mean, I'm reading articles from 8 to 12% in some areas. I mean, that's a $500,000 house that may sell for $540,000 a year from now. So it's still a good time to be a buyer if someone's financially ready. It's a tough time to be a buyer, but I still think being out in front of it, rates are still historically low. You're still talking about, a 3% interest rate or 3.25% interest rate. It's still a tremendous rate on the long term that someone's willing to give you $300,000, $400,000, $500,000, $700,000 at a 3% interest rate for the next 30 years. Money is very cheap. It's still a good time to get in. If you have the patience to kind of battle it back and forth with other buyers.
And that's the other thing. It's like, say you're approved for 500, but like you want to put a 5.25 in offer, speak to your loan officer, see how much it's going to increase your monthly payments. Sometimes it's less than a Starbucks coffee a month,
That's
depending
correct.
on what you're drinking or eating that month. You might say, let me cut back on Starbucks. We got another question in from Erin. So she's talking about selling to buy and the equity. So Erin, we did touch this briefly, but basically if you're going to sell, so right now where you're living, say you put it on the market, if you have to sell to buy, you'll still need money to sign contracts for the down payment of the new purchase. And that's something that we covered. So you'll definitely still need money, like your house should be in contract if you're selling to buy. Then you put an offer in on the new property, but you will need earnest money to sign the contracts. And then you could take the rest of the equity at closing. And Frank, you want to cover a little bit of closing costs for a home in Queens? Because obviously it's a little bit more pricier because you have the city tax too in Queens, in the boroughs.
Sure. When it comes to closing costs, New York is different than other places. A lot of what's posted online is you could kind of say, hey, there's a percentage, right? It's 3%, 4% of the sales price. It's really difficult to do that in New York. And the reason being, especially in Nassau County, Suffolk County, north of the city, Westchester North, property taxes drive your closing costs just like they drive your monthly payment more than anything else. So it's really hard to use a percentage of a purchase price to say, hey, it's 3% or 4%. Property taxes are going to drive your closing cost. In the 5 boroughs, property taxes are much less. But what happens is your mortgage tax, the taxes that's collected against the mortgage that you're taking out, is much greater. It's 1.75%. So if you borrow $500,000, a $500,000 mortgage in the 5 boroughs, you're going to pay almost $10,000 in a mortgage tax alone before any other expenses, before any property taxes, homeowners insurance, before your attorney's cost, before any title related costs. So you have a greater initial outlay in the 5 boroughs, but you'll have a lower monthly payment, for argument's sake, because the taxes are much lower, right? We have properties that we're seeing in Queens and Brooklyn with $5,000 or $6,000 or $7,000 in taxes, and the sales price, $600,000, $700,000, $800,000, $900,000, where that property, Nassau County, Suffolk County, you may have $20,000, $25,000 in taxes, but you'll have a lower mortgage tax. But in the 5 boroughs, you're going to pay more upfront in terms of closing costs with a higher mortgage tax, but a lower monthly payment because taxes are going to be, generally speaking, will be lower in the 5 boroughs than they will be on the island.
And then the other thing is you got to think of income taxes, right? So when you're living in the city, you're still going to pay city taxes on your income. When
you pay resident tax.
Yeah. So it's like kind of like, you'll pay less taxes when you move to Long Island out of your, federal and state tax, whatever,
Yep.
but you're going to pay more.
But you're going to pay more in property. I don't know that there's a real right and wrong answer, right? It really comes down to, hey, where I work, I have to be closer to the city, and maybe it's, it's Queens, and, for some people say, hey, and once again, you going back to COVID, right? We all work from home. I mean, that's a, it's completely new to a lot of us. I mean, we were working from home for 2 years, and a lot of people haven't gone back, right? They're set up at home, and they work remotely, and, they were able, and that's part of why we saw what we saw on the island, right? So many people that now were living and working in the city didn't have to anymore. So they ended up either giving up their places that they owned in the city, or they ended up giving up their rent, and they started heading east. And that drove what we saw the last 2 years on the island and north, for all these people that were, kind of trying to get out of the city because they wanted to spread out a little bit more, and now they're working from home, and now you have buyers that were paying so much in rent that now an extra $30,000 or $40,000 over asking price, or $100,000 over asking price, it was still cheaper than them paying rent, right? And that's what drove a lot of kind of these bidding wars and these, crazy contingencies and things like that, where people just had to have a house. It was still less than they were paying in rent in the city or in Brooklyn or Queens. And they said, hey, you know what? I can get this house in Nassau County and Suffolk County, and even if I have to go $100,000 over asking price, I'm okay to do that, because it's still less than what I'm paying in rent. And it's something where, we're not seeing it to the same extent now, but it is still, the work from home piece is still part of it.
Yeah. And so the owner that owns my office also owns the Manhattan office for Keller Williams. He just bought it. I'm friendly with a lot of agents in the city, and Manhattan is actually higher than pre-COVID right now. So rentals are through the roof again, because people are moving back, because, there are talks with, hey, I had a conversation with someone who's retired from Con Ed that I used to work with. And he was saying, as Con Ed leadership, we have a responsibility to get the city back up and running and being part of that. So to say, hey, let's let all workers work from home, that might not be the best case scenario, right? So it's they do have a duty and responsibility to get the city back to where it was at one point. And I mean, the city is booming in that aspect of the real estate market. It's back to pre-COVID rates, where you might have been able to get a little bit of a deal the last year and a half, 2 years, but not anymore. So you're going to see a big shift in that as well. So it's pretty interesting, the market that we're in and where we're going. But I want to see if anyone else has any other questions, to be mindful of everyone. You all should have a podcast. So many gems. Thank you, Isabel. I appreciate it. She's so cute. Any other questions? Well, I'll be mindful of everyone's time. Thank you so much, Claribel, for your amazing presentation. And
Great job, Claribel.
next time you want avocado toast, you're going to think about saving some money for your down payment. That's for sure. And thank you, Frank. I mean, he's always a resource for us. Like I said, like, you know, whether it's appraisals, anything, like I'll text Frank, like, are you available to talk? Like, can you give me
Always.
a hand? You know, so he's been
Always.
very helpful to a lot of our clients. And Jackie is with our team. We're so excited to have her. She's got her little watch party going on over there. And Kay's sad that she couldn't be with us. But any other questions, you guys could always reach out. I'm going to send a follow-up email with everyone's contact information. We are here, whether it's learning to plan, to buy, to save. We got you. Have a great night, everyone.